Hi everyone, we're looking at our next micro topic of growth. So to date we've covered short run costs, we've looked at revenue, we've looked at profits, and we've just been looking at the long run economies and diseconomies of scale. So in this topic we're going to have a look at why firms grow, and also is there room for small firms as well. In terms of the screenshot you can see some of the world's most valuable companies. Okay, things that we have to be able to do. We need to be able to identify why small firms continue to exist and how they're successful. Look at ways in which firms can grow, and we must have real world examples. Make a note of that. We've got to contextualize our responses. When we get to 10 mark and 20 mark essays, we've got to be able to quote those in the exam. Also, possible benefits to firms of such growth. And then look at the evidence on the success of takeovers and mergers to date. Okay, so in your notes, you guys should be looking at page 47 and starting off towards the bottom, looking for the reasons for survival and success of small firms. Well, some of this might be large firms contract out some parts of production, so the likes of Bellway Homes and so on would have a small or a medium-sized permanent workforce, but then they get a big contract and they will call in small firms of electricians, plumbers to do work, and then as soon as they've done, they go back and look for other jobs. Okay, so that will allow some firms obviously to continue because that work is sourced out to smaller companies. Small companies provide niche markets, normally in elastic demand for such products, so that can be a reason for them surviving. Obviously, small firms may not want to get too big because they can avoid diseconomies of scale. They're very good innovators usually, and in terms of online technology, that's reduced setup costs, allowing small firms to exist, and in some there are a few economies of scale to be gained, such as hairdressing, for example. And also lastly, and an interesting reason, some larger firms don't want to dominate a market too much, because if they do, if they have that high level of market share, then the competition authorities, the CMA, the Competition and Markets Authority, may start to get interested and want to intervene in such a market. So larger firms will tolerate smaller firms. They won't try and take them over or have a merger. They won't try and price them out of the market and push them into administration because it suits their purpose, because they don't want those closer attentions of the Competition and Markets Authority. Okay, why do firms grow? I think importantly, there are a number of reasons for this. So just in terms of this, so I'm just going to get a laser pen here. Strategic motives, obviously that's very important, and in terms of this, economies of scale can be a big one. With economies of scale, you get that lower average unit cost, which will make you more price competitive, or alternatively give you higher profit margins. Obviously financially, in terms of this, well, the owners, the shareholders, will want higher profits and higher dividends. And then a third one, and we'll look at alternative objectives of the firm, things away from profit maximization later on in the course. Managerial motives, where managers aren't the owners, maybe the managers are going to operate in their own self-interest. For example, to meet sales targets, as long as they make enough profit to keep shareholders happy with the level of dividends they get, maybe they will target other things like sales maximization because their targets are based on that, and they will get higher bonuses as a result. Okay, so what are the advantages of growth? We've mentioned economies of scale, build and sustain market power. Now, just in terms of that, that's an important concept. So I just want to stress that market power. That means monopoly power, the ability to set price. Make sure that you're aware of that. We know about shareholder returns. It will also reduce the risk of a hostile takeover because you maybe have merged or grown to such an extent that it would be too expensive for another firm. We've talked about the pursuit of managerial objectives and then the idea of synergy effects. So in terms of this, two firms, in terms of almost the energy, the way they work together is better than both individually. So the combined profits would be higher, the combined sales would be higher by having one individual firm in terms of two smaller ones. Okay, disadvantages of large firms. Now, be very aware that this might be the case and have some points to hand. So you've got these on page 49. So mass-produced goods aren't always desirable. So whereas we say, well, that might lead to economies of scale and lower prices, be able to counter that. Have a counter argument, really important when it comes to our 20 markers. So it would limit consumer choice because you've got standardized products. Sometimes they can be quite slow to respond, too many rules to follow, and so on. And potentially also they could suffer diseconomies of scale. So some of you might be thinking, well, an advantage is they could benefit from economies of scale. However, what's the counterpoint? They can suffer from diseconomies of scale, okay, if they become too big. Okay, in terms of methods of growth, sometimes internal growth, sometimes called organic growth, so from the business itself. So think of the likes of Subway, think of the likes of Domino's Pizzas. They've grown through a franchise. Sometimes they can grow firms from selling new products or expanding into new markets, maybe internationally. External growth can be via merger or takeover. Now, in terms of internal growth, this is a nice example. It's a bit dated, but you know, it's a good one. So this is Sky, and in terms of the amount of customers that they had, back in 2004, it was 7.6 million. By 2010, yes, they'd grown the number of customers, but organically, what have they done? They've actually tried to sell. Let me just change my highlighter here a second. They've actually tried to sell more products. Okay, so in 2004, they were selling 8.1 million products. So in terms of that, almost one product per customer, but by 2010 it was 2.3. Okay, so by selling extra packages, whether it's your broadband as well as your TV, whether it's movies, whether it's additional room and so on, all of these things have helped them to grow. Why do they do that? Because it's cheaper to get existing customers to buy more goods than it is to get new customers. Okay, so from a business perspective, it's cheaper to get existing customers. They already trust in you. They're already buying your products. Cheaper to get them to buy more products than it is to get new customers. Okay, in terms of internal growth, could you guys please make a note, page 50, you must know these, okay? So in terms of the advantages and disadvantages, we'll focus on the advantages first of all. What are you doing? Well, you're building on your strength already. It's clearly going to be less risky than taking over other businesses. You can grow at a sensible rate, and you're doing that how? Maybe through retained profits. Okay, so that's really important. The disadvantages, well, how quickly you can grow depends on how fast the market is growing. Some businesses, the likes of Tesco and so on, once they got to 30, 31, 32% market share, people start to be a little bit cynical about your business. Too much market power and very difficult to continue to grow. And obviously we know what's happened in the supermarket industry, and new models have come along. People are shopping more frequently, which means smaller shops are becoming more in vogue. And so the likes of Aldi's and Lidl's have gained in that regard. Other disadvantages, well, organic growth, internal growth is slow. Shareholders want quick growth, more profits, more dividends quickly. And also, if you grow through franchising, I mentioned that before, so anyone can operate their own Subway and so on if they pay Subway enough money and they convince them that they can run the product in a worthy manner. So there could be quality issues if there was issues in terms of training, cleanliness, and so on. Okay, so these are key pros and cons to be aware of. Okay, you should now complete the Aldi activity on page 51. Okay, so this will take you around 8 to 10 minutes. Have a read and highlight pros and cons. Split your table on page 51 into 2 columns, pros and cons. Make sure you use the effective wider reading technique. So important that we practice that whenever we get the opportunity. And then we will run through that together in around 10 minutes time. Okay.